Hello and welcome to the Canaccord Coffee Break podcast. I'm Jane Parry, the Chief Marketing Officer here at Canaccord Wealth, and I'm delighted again to be joined by Tom Hibbert from our Chief Investment Office.
Hello, everyone.
Tom is our Chief Investment Strategist, and he is here to help me cut through all the noise of what's going on in the markets, hopefully demystify it in a simple and easy to understand manner, and then you can feel more informed, more confident and more in control of your financial future.
Another interesting week.
An extraordinary week. Geopolitics and the markets all having fun again.
Yeah.
Welcome, and grab your coffee. Let's dive on in. So this time last week, Tom, we were talking about Trump's ultimatum, which was followed by the announcement of a very fragile 2-week ceasefire between the US and Iran.
Yes.
Since then, global equities have gained
4.1% in dollar terms.
Yep. So just give us a brief summary of what's happening in the markets off the back of that.
Sure. I think the ceasefire took everyone by surprise, really. And we saw a very strong reaction across financial markets, everywhere you looked.
Yeah.
So US equities led the rally. So global equities up 4%, 4.1% in dollar terms. US equities led, technology outperformed, all of the areas most sensitive or weakest since the conflict began performed best. We saw this similar in credit markets. Credit spreads tightened, which means they outperformed, tightened forcefully, almost back to where they were before the conflict began. So quite remarkable performance within credit markets. Government bonds as well, UK gilts, which we've spoken a lot about, performed very, very well. On the flip side, energy, which has been performing well when we've had higher oil prices on the back of the conflict, obviously fell back last week. So energy was the only sector within the global equity market to post negative returns, and the oil price softened as well. So it fell back below $100 a barrel.
Okay. So markets seem to be taking some comfort from the ceasefire.
Absolutely.
Yeah, at least for now. Even if perhaps the underlying risks haven't completely disappeared.
Not at all.
Not at all. So just let me pick up on oil.
Just to say, so the underlying risks, they've obviously not disappeared at all, but the chance of more de-escalation after an initial ceasefire has been announced is obviously more likely. Yeah. So the path to de-escalation, I think, is clearer than it was last time we spoke. So a lot of positives that I think justify the strong performance, but
I think that's fair. Yeah. And we like to be positive on the podcast, don't we?
Exactly. Let's pick up on oil.
So let's go back to oil then.
Sorry.
So we've been talking about the rising oil price for a few weeks now and the risk of supply side inflation.
Yes.
You just mentioned that oil prices fell back a bit last week.
Not back to where they were.
Definitely
and
not
already
back
again, they're now back above $100 a barrel.
Okay.
But before the conflict began, they were in the high 50s, low 60s.
Okay.
So
there's considerable.
They're still considerably higher. There's a big premium on the oil market, and this is still a major supply side shock.
Yeah.
And in fact, the energy is still, the flows through the Strait of Hormuz is still completely paralyzed despite the ceasefire. So
So is this why the markets are starting to talk about the risk of stagflation?
Yes. So stagflation's high inflation and low growth.
High inflation and low growth. Okay.
Yeah. And when you have high energy prices, it's basically a tax on growth.
Yep.
And it's obviously inflationary.
Yes.
So when you have an energy shock like this, it is a vast stagflationary impulse across the global economy.
Okay.
So, and before the conflict begun, economies were already slowing. Economic growth was already slowing. It looked like inflation was falling.
Yep.
Now you've got this big supply side energy shock.
Yep.
The risk of stagflation has suddenly increased dramatically.
So as if the foot's been put on the brake.
The brake or in terms of economic output,
yes.
economic activity, and the accelerator in terms of inflation.
Aha. Okay. But I was just thinking about the cost of filling up your car with fuel at the moment. It's gone up hugely, hasn't it?
It
at
has.
The pumps.
We saw that in the US last week as well, actually, where US inflation jumped to 3.3%, a big increase, entirely driven by gasoline prices.
Yeah. Okay.
The risk, though, is if inflation, the second order effects of high energy prices, if we see inflation broaden out across the rest of the economy, which can happen. There's less of a transmission, which we've spoken about on this podcast in recent episodes, but certainly that's a risk that everyone's concerned about.
So why is stagflation then such a sort of loaded word for investors, for our clients?
The consequences for financial market returns can be significant.
Okay.
Because if you have low growth, like a recession, markets tend to perform poorly.
Yeah.
And then you add on inflation as well. Most people want to beat inflation because that is the cost of the cost of living.
Yeah.
But if you're losing money from this growth shock and you have high inflation, your real returns aren't just negative, they can be deeply negative.
So it's like a double whammy.
So it's a double whammy.
Okay. So as investors, we really don't like that word.
No.
Okay. Just thinking about portfolios then and how we're managing through this for our clients, which assets tend to struggle most in a stagflationary environment and perhaps which are a bit more resilient?
As a multi-asset investor, we tend to combine global equities and global bonds.
Right.
And for natural diversification.
Yeah.
That doesn't really work when you're in a stagflationary environment.
Okay.
That means that we want to build portfolios. There are still parts of the markets that can protect you during these sorts of environments.
Yeah.
Things like very short-dated parts of corporate bond markets, if you short-dated debt, alternative areas of credit, asset-backed securities is an area that we particularly like. You're not exposed to interest rate risk if central banks raise interest rates. If you buy higher quality asset-backed securities, then you're less exposed to a growth shock as well, so that they can perform very well in a stagflationary environment. Commodities can perform well. Oxford University did a study that showed that during inflationary regimes, when inflation's high or rising, no commodity works all the time. No. You should own a broad basket of commodities.
Okay.
Right now, it's all about energy, as we've spoken.
Yeah.
But in other inflationary regimes, it's gold that works best.
Yeah.
So we like commodities, broad commodities, but at the moment, it's obviously all about energy when you have a geopolitical shock and an energy shock. From a long-term portfolio construction perspective, I think active management is absolutely key, because when the risks are tilted to the demand side, you want to, like a recession, you want to lower your risk and you want more government bonds. When risks are tilted to inflation, to the supply side, you want to be a little bit more tilted towards alternatives, things like commodities, short-dated credits, asset-backed securities, the things I've mentioned. Inflation-linked bonds can be good, an interesting place. You need to be able to understand them. They can be complex, but they're performing pretty well at the moment. So there are areas to hide, but being active from a top-down perspective is absolutely key. And that, I think, it actually embodies our philosophy at Canaccord.
Yeah, I was going to say, it goes without saying that we are active wealth managers for our clients, aren't we?
Yeah, and we really understand a lot of these markets. The inflation-linked bonds, asset-backed securities are key parts of our
some of them
portfolios.
are quite specialists, I think.
They are.
Yeah. Is there anything else we need to know, just thinking about long-term portfolio construction or just about people thinking ahead?
No, I would say that we have this period of weakness, but it is set within a very strong period for markets.
Right.
We spoke about it last week. When you look through this fog, and you note the uncertainty, and you look at what you can see, the fundamentals, and the fundamental backdrop is still pretty positive.
Okay.
We're coming into earnings season now. There's a lot of optimism, and I think we should see some pretty strong results. We're off the back of 4 quarters of US companies delivering double-digit earnings growth. That's a positive. Even from a fiscal policy perspective, we're still in quite a stimulative environment. So there are some reasons to be, a number of reasons to stay positive, and I think the investment case is still pretty strong.
Good. Brilliant. Thank you very much. So probably time for me to have a quick look what is in my Canaccord takeaway coffee cup today. So we're clearly not at the end of the conflict or the end of the uncertainty around the Strait of Hormuz, but we are a bit more hopeful that we can see an end in sight. Energy and geopolitical backdrop remains a key risk, even when oil prices temporarily fall. So we've been talking about...
the situation's shifting quickly. Right now, it's still evolving.
Yeah, but what that's why it's important, resilience, diversification.
And looking through the fog.
Yeah, long-term planning. Yeah. Probably more important, actually, than reacting to some of the short-term price moves we're seeing.
Absolutely. You can be tactical here and there, but the long-term opportunity set is what tends to prevail.
Great. Well, thank you very much. Thank you for your time. Thank you for explaining stagflation to me. I enjoyed that.
Pleasure.
And don't forget to follow us on Spotify or Apple or your podcast channel of choice. Just hit follow. You will never miss an episode. If you've got any thoughts, please share them with us or drop Tom an email, coffeebreak@canaccord.com. Thank you very much.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.